Hey everybody, what's up? We are back with another stock analysis, and today we will be looking at Shopify. Shopify does online commerce. They are a massive company with a ton of growth in the past couple years, and we are going to be going through an analysis of them, focusing on some key financials that I've found. A new thing I'm going to be doing now is trying to keep these videos under 10 minutes. I just think that helps with like retention and getting the most valuable information as fast as possible. So we're going to try to hit that mark today. Make sure to subscribe if you haven't yet. Comment, like below. Let me know what companies you guys want me to review. Let me know what you think of the videos, and that's about it. So let's get into Shopify. So starting off with Shopify, just to give you a quick rundown of the company, cloud-based commerce. They basically make mobile or online storefronts for companies. So some things to look at: massive new order value increases over the next year, going from about 7 billion to almost 11 billion just within 1 year, which is enormous growth. Gross merchandise volume is increasing from just under 300 million to now. This could actually be billions. Let's look. And I'm not seeing a number anywhere. So we are going to go ahead and assume that is millions. Going from just under 300 to over 350 million, which is outstanding growth as well. Recurring revenue also showing huge increases over the next year. And then expenses, of course, are also going to increase alongside those. So some key statistics before we get into everything here. Market cap is currently at 132 billion, no dividend, and target price is at 132 with a 14% long-term growth rate. Right now we are at 138. Let's see if this is in US dollars, which I'd imagine it will be. Okay, and not 100% sure, but I am going to assume that it is in US dollars because everything else here is at the moment. Yeah. So anyway, moving through here, we're going to get into their earnings and see how they've been doing recently. While that is hopefully loading up for me, I want to show the chart. So the stock was trending just a few days ago, possibly when their earnings came out, but probably not. I think I only added it a couple days ago to my list. So probably just another one of those stocks that were down a ton with the overall market. One thing I would like to point out is that this company was extremely overvalued for a very long time. It has since come down from that massive valuation that we saw back in the end of 2021. However, they do have an incredibly high PE ratio, which we will get into in a few minutes. But just to point out that although they are lower than they used to, they are still considered overvalued on a couple different metrics, which is something that you could be concerned about. But personally, I think that this company is showing more than enough growth to justify the numbers that they're showing. So let's get into the metrics recap first off and see how they performed in this last earnings report. So subscription revenue beat, merchant revenue beat, gross profit beat slightly as well. Gross margin came a little bit below. Gross profit, subscriptions came in below, merchant came in above. Adjusted operating income came in significantly above, and margin also beat slightly, which is arguably a little bit more important than the gross margin. Missing slightly, the operating margin did beat, which in my opinion is a bit more important. Recurring revenue was slightly below estimates, which could be pretty negative. Recurring revenue is probably the most important revenue because it is the most consistent and kind of builds a foundation for the business. And merchandise volume beat as well by about 2 billion, so looking pretty good on that front. Let's keep moving through here and go into what the analysts are saying about the company. So management guide Q1 revenue fairly in line with consensus, with growth in mid 20% year over year and gross profit to grow to low 20% year over year. Commentary from analysts was fairly positive, with most pointing towards record merchandising volume, which is very good. Some other improvements: inline Q1 guide as positive, with some calling it a little bit conservative. The shares were up on the report, which says what you usually need to know about the report, is that it was fairly positive. Several analysts highlighted some tailwinds from more of a strong customer base and international growth. Some analysts also believe that improved visibility is deserving of expansion, while pointing to peers trading at a significant discount. So that could be an issue for the company in the future, with them possibly not being the first choice for investors just because of how overvalued they are. Like I was talking about earlier. One thing I will say is that a lot of price targets here are being raised. This report came out February 12th. Let's look at where the stock price was then. So right around here with a high of around 128, almost at 130. So when this came out, let me go back over here. A lot of these price targets were actually underneath or right in line with where the prices were at the stock. Now we are significantly below that at under $100 a share. In my opinion, that still does not mean that the company is undervalued, however, only because, as we'll get into in a moment, their PE ratio is very, very high, which actually, let me just show that before I get carried away and start talking about other stuff. So, one thing that I always look for is the PE ratios of companies, and I show just how they are compared to other companies that are similar or in their sector. So the most recent yearly PE they had was 84.8. Next year, it is expected, or I guess I should say, this year it's expected to be at 64.1, which is slightly better, but any company that you see will have vastly lower PE ratios, which implies that this company, compared to how its earnings are, is significantly overvalued. And just to show that again, so I don't distract myself later and forget about it, I will show them compared to their competitors. So the here is the PE ratios of their competitors, including things like PayPal, Block. I've been hearing about Corpay a little bit more recently, but looking at the PE ratios here, it's pretty crazy. So every single company listed here is significantly lower than Shopify. If you look at the average, it is less than half of what Shopify is. And if you look at the current fiscal year, I believe that's what FY1 means, and then the next fiscal year, it is still by far outweighed by every other company. Shopify is much higher than everything else listed. So overall, they are very much perceived as overvalued in those regards. So that is something to keep in mind. Does that mean that they're going to have a huge drop off? Probably not. But at the same time, with the weakness that we've been seeing in the market recently, overvalued companies are pretty likely to take larger hits because of circumstances like that. So that is something to watch out for. However, again, this company has been delivering very strong results, predicting very strong growth. So that could hopefully cancel out some of those negative aspects that we were talking about. So anyway, getting into the financials, we're seeing pretty good sales growth, 7 billion to 8.8 billion. SGA is actually decreasing year over year despite the sales increase. Operating income saw an enormous increase year over year, and net income $2 billion in profit after 100 million last year. One thing to note is that they actually had way higher net income back in 2021. Most likely just because of COVID, everyone was inside setting up their new online stores that they have. So that is something to consider. 2022, they took a big hit, and now they are clearly on the path towards growing a lot more. So that is something to be optimistic about. Saying that, let's keep moving on through the financials here. So balance sheet, they have 5.5 billion in cash at the moment, and just about 1 billion in debt. So the debt situation is very good. Their debt to equity ratio is just about 10%, possibly a little bit less than that, which is very healthy. Everything here looks pretty solid, very consistent asset growth, other than, of course, 2021, where they had a very unique year, to say the least. Moving on, cash flows. So for the company, we're seeing the operating cash flows look pretty good. They did, of course, have that one stutter year in 2022, which I believe was mostly just because of added expenses from 2021 that carried over with some headwinds. But either way, they are looking fairly solid now. We're seeing a lot of investments being purchased over the past 2 years, with about $1.6 billion being put into it. Um, the total stock is being I should say they are issuing stock every single year, so they're using that to get a little bit of money. But honestly, based on how low the numbers are here, I wouldn't think it's anything too major, possibly employee compensation or just a little bit of funding. But overall, it's such a small number that I doubt it's anything to be worried about at 61 million. And saying that free cash flow is positive for the last 2 years. Again, 2022 being the rough one, but overall, we're seeing it at the highest number they have ever seen, which is excellent. And finally, last but not least, going into the ratios. I already talked about the debt to equity, so I won't scroll all the way down there, but gross margin saw year over year improvement. Operating margin, huge improvement. Same thing with net margin. ROA, ROE are both the highest we've seen in 3 years. And again, that is including 2021, where it was kind of an outlier year because everyone was at home using online stores. So it was a little bit skewed. But overall, that is all I have for Shopify today. Looking at the company, I still think they are very overvalued just based on their PE ratios. Also, another indicator of some possible slowdowns in growth is that their workforce, if we look down here, has been cut significantly over the past 2 years, dropping 28% in 2023 and then another 2% in 2024, which isn't really too major. But one thing to note is that despite those drops, their earnings are still fairly positive every quarter. And we did just see they had massive record numbers and a lot more growth projected. So overall, it probably won't hurt them too much, but it is just something to consider. And saying that, that is all I have for Shopify today. Thanks so much for watching. Make sure to subscribe if you haven't already, and I'll see everybody in the next video.